But with Wall Street now recalibrating its Fed expectations, is the rally set to run out of runway? Let's ask Lauren Goodwin of New York Life Investment Management back at Post 9. Nice to see you again. What is the post-Powell playbook now? Do we need to do something different because of what he said yesterday?
You know, the market took Powell's comments yesterday as a bit of a hawkish surprise, and you saw that expectation of a March rate cut move, lower probability. But I don't think a lot has changed here. The economic data are still pointing to being a little too hot for the Fed to move assertively. And so we believe primarily that the next move down in rates and therefore needing to add duration is still a little bit away. And so we're staying short duration in our credit exposure as a result.
Fed, some firms, it's like one firm today said, I'm still staying with March. Most people have bumped it back to May. Some still have June for the first cut. Does March even matter? Or is it the fact that cuts are coming? And ultimately, that matters more than who cares about March? If it's May, June, does it matter?
For day-to-day equity market moves, yeah, conversation about March versus May matters on the margin. But for a balanced investor portfolio, it is all about the top bond rates having come in. And we're actually seeing finally cash move off of the sidelines as investors recognize, hey, it may actually only be 6 more weeks that we have to lock in yield on the front end of the curve.
Let's talk about that. I asked Jeffrey Gundlach yesterday, of course, right after Mr. Powell finished his news conference, sort of where's the best place to be? Likes cash. He thinks that a lot of risk assets, not only equities, but along the credit stratosphere are extended. Here's what he said he likes about bonds.
The real interest rates on treasuries appeared attractive to me, particularly that the Fed is staying higher for longer and may, by that process, engineer a lower inflation rate than 2% by the end of this year, which would make bonds, treasury bonds, very attractive.
Agree?
I agree to a point. I still see not only a little bit of price opportunity, but some significant yield opportunity in credit. And I think that especially if, again, we expect the next Fed move to be a cut, it's important to start moving cash off the sidelines. Now, as economic growth slows, spreads are going to widen. Absolutely. And so that creates some price risk. But you're still harvesting major yield even on the short end of the curve. And so one of the things that we've been speaking with investors about is, not only move out of cash and into bonds, but consider taking some of your equity-like risk in bonds, especially in high yield where you have equity-like returns and equity-like price risk.
Well, he was talking about high yield that, that looks expensive and extended. You don't agree?
It's expensive from a price perspective, but again, relative to an expensive equity market, you still are getting between 8 and 10% on the high yield index as a total return, which is pretty meaningful.
Sure, but you're taking on a much higher level of risk at these levels, I think was his point.
I don't necessarily agree. I think even as growth slows, and you and I have spoken about this a little bit, even as economic growth slows, if we see
allegedly
a mild recession.
Atlanta GDP now was like 4.2.
I know. But let's say that we do see growth slow from here, spreads are going to widen. But if that's the case, we're going to see much less widening and a much lower default rate in this credit cycle than we would see in a normal recession scenario. And so I don't think that price risk is anywhere near in high yield or in the credit space writ large what it could be in the equity space and what it's been relative to past slowdowns.